Opendoor Technologies, ticker OPEN, is currently trading at $7.57, down a very sharp 57 cents, or a drop of exactly 7.00% on the day. Now, on the surface, a 7% slide looks like a brutal reaction to some piece of bad news. But the real story here is far more structural and, frankly, more concerning for anyone holding the stock. This isn't just about one bad trading session. It's about the market waking up and questioning the very foundation of the iBuying model in an economic environment that is becoming increasingly hostile to it. The initial promise of Opendoor, the grand expectation, was that technology could finally streamline the archaic process of buying and selling a home, turning an illiquid, complicated asset into something as simple as trading a stock on your Fidelity mobile app. The idea was to use algorithms and vast sums of capital to create a frictionless market. Investors, especially those who made fortunes on names like Tesla stock or Nvidia stock, saw another tech disruptor ready to conquer a massive, old-fashioned industry. The reality, as today's sell-off demonstrates, is that you can't just slap a tech label on a business and expect it to be immune to real-world economics. Opendoor's business model is fundamentally about taking on inventory risk. They buy homes, hold them, and then sell them. This makes them less of a pure tech company and more of a high-tech real estate flipper. And that business is exquisitely sensitive to interest rates and housing market sentiment. The Federal Reserve's aggressive stance on inflation has sent mortgage rates soaring. When mortgages become more expensive, buyer demand evaporates. When demand evaporates, home prices stagnate or fall. For a company like Opendoor, which is holding billions of dollars worth of homes on its balance sheet, that is an existential threat. Today's 7% haircut isn't an isolated event. It's a reflection of the market's growing anxiety that Opendoor's inventory could be turning from an asset into a massive liability. The volume we're seeing today is significantly higher than the daily average, suggesting this isn't just retail investors on Robinhood getting spooked. There are signs of larger block trades, indicating that larger institutional funds might be trimming their positions, reallocating capital away from high-risk, interest rate-sensitive names, and perhaps into more stable assets available through their Fidelity wealth management advisors. This kind of institutional selling creates significant downward pressure and can signal a broader loss of confidence among the so-called smart capital. Let's dissect the recent price action to get a better sense of the trend. This decline didn't start today. Over the past month, the stock has been in a clear downtrend, consistently making lower highs and lower lows. Each attempt at a rally has been met with renewed selling pressure, a classic sign of a stock under distribution. What's different today is the acceleration of that decline. It suggests that a key support level has been breached, triggering a wave of stop-loss orders and further panic selling. Many traders using platforms like Interactive Brokers with its advanced charting tools would have identified these critical levels, and their algorithms would have likely executed sell orders automatically the moment they were broken. This is the new reality of online investing. It's not just about long-term fundamentals, but also about understanding the technical picture and the flow of capital. The dream sold to many doing self-investing was one of smooth, upward growth from a disruptive company. The reality is a volatile stock being pummeled by macroeconomic forces far beyond its control. The comparison to other tech giants is telling. While a name like Apple stock has its own challenges, its business isn't directly tied to the cost of a 30-year mortgage. Opendoor's is, and that's a critical distinction the market is making right now. The core business model itself is what's under the microscope. Opendoor and its iBuying competitors aimed to solve the uncertainty and hassle of selling a home. They provide sellers with a near-instant all-cash offer for their property, closing in a matter of days instead of months. They make their income in two primary ways: A service fee, which is typically around 5%, comparable to a traditional agent's commission, and the spread they hope to achieve by reselling the home for more than they paid for it after making some light repairs. In a hot housing market with rising prices and low interest rates, this model works wonderfully. Inventory moves quickly, and appreciation adds a nice tailwind to profits. But we are no longer in that environment. The expectation was a smooth, scalable tech platform. The reality is a capital-intensive business that is deeply cyclical. When the housing market turns, as it is now, that model is flipped on its head. The risk of overpaying for homes becomes immense. The cost of holding those homes on their books, financed with debt, skyrockets as interest rates rise, and the pool of potential buyers for those homes shrinks by the day as mortgage affordability plummets. This is the fundamental conflict that investors are grappling with, and it's why the stock is being punished so severely. Platforms offering investment help, like Schwab Intelligent Portfolios, are likely reducing their exposure to sectors so directly impacted by Fed policy. Looking back, the warning signs were there. When Zillow, a much larger and more diversified company, famously shut down its own iBuying operations late last year after reporting massive losses, it should have been a major red flag for the entire sector. Zillow admitted that its algorithms couldn't accurately predict short-term home price fluctuations, leading them to overpay for thousands of properties right before the market began to cool. Opendoor insisted its technology and execution were superior, and for a while the market gave them the benefit of the doubt. But the underlying vulnerability remains the same. No algorithm can perfectly predict a housing market downturn, and no amount of venture capital can insulate a balance sheet from the consequences of holding depreciating assets financed with increasingly expensive debt. Investors using SoFi Invest to manage their portfolio, who might have bought into the growth story, are now facing the harsh lesson that not all tech is created equal. Some tech companies are just old business models with a new user interface. For a genuine tech investment, you look for high margins and low capital intensity, like a software company. Opendoor has razor-thin margins and is one of the most capital-intensive businesses imaginable. Comment below with your prediction. Do you think rising interest rates will force Opendoor to drastically alter its business model within the next 12 months? I'm genuinely curious to see what the sentiment is out there among those who follow this space closely. The conversation around the company is shifting from one of growth and disruption to one of survival and balance sheet management. The company's last earnings report, while showing impressive revenue growth on a year-over-year basis, also revealed a significant increase in inventory and a compression in contribution margins. Analysts on the earnings call grilled management about their strategy for navigating a cooling market, and while the answers were confident, the stock's performance since then suggests the market isn't entirely convinced. They spoke of adjusting their offer prices and being more selective, but that's easier said than done. Adjust too aggressively, and your offer volume dries up, cratering revenue. Don't adjust enough, and you're stuck with overpriced inventory you'll have to sell at a loss. It's a precarious balancing act. Many investors on investing sites are watching the housing data even more closely than Opendoor's own financial reports. Every new report on existing home sales or median home prices is now a direct data point on Opendoor's future prospects. Looking forward, the path for Opendoor is fraught with challenges, but not entirely without opportunity. The bear case is clear and is what's driving today's price action. A prolonged housing downturn, fueled by high interest rates and a potential recession, could lead to significant inventory write-downs. This would hammer their profitability and could even raise questions about their liquidity if the capital markets tighten. They would be forced to sell homes at a loss simply to free up cash, creating a death spiral. This is the reality that has supplanted the initial rosy expectation. However, there is a bull case, albeit a more distant and conditional one. If Opendoor can successfully navigate this downturn, proving it can manage its inventory and costs effectively in a tough market, it could emerge in an even stronger position when many of its smaller, less capitalized competitors will likely be wiped out, leaving Opendoor with a larger share of the market when the housing cycle eventually turns positive again. If they can demonstrate that their data science provides a real edge in pricing risk, even in a down market, they could win back the market's trust. A successful navigation of this period would be a powerful proof of concept for their model. Traders using a sophisticated interactive brokers platform might be looking for signs of stabilization in the housing market as a potential entry point for a high-risk, high-reward contrarian play on Opendoor. It's a bet that the company can survive the winter and thrive